Welcome to this explainer. Grab your mental markers because today we are sketching out the absolute core concepts of Benjamin Graham's legendary book, The Intelligent Investor. We're going to literally build out your ultimate visual notebook for financial success, chapter by chapter. We'll be focusing heavily on the all-important margin of safety and the wild psychology of the market. So let's just jump right in.
Okay, Section 1, Principles of Intelligent Investing, Building the Foundation. Here is where we map out the core rules that separate genuinely smart investors from reckless speculators.
You know, what's really fascinating here is to look at someone like Sir Isaac Newton. I mean, the guy was a towering genius, right? But he still lost a total fortune in the South Sea bubble of 1720. And why? Because he allowed the madness of the crowd to completely override his own emotional discipline. It perfectly illustrates Graham's very first point. If you want to succeed, character and emotional control will be raw IQ every single time. And honestly, that discipline is the absolute dividing line between true investing and just speculating. Look at Chapter 1. Real investing actually promises the safety of your principal along with an adequate return. Speculating? Well, that just relies on random statistical flukes. Think of those get-rich-quick schemes like the so-called Foolish Four. Those formulas always eventually fail because they're relying on pure dumb luck instead of analyzing the underlying business value.
Moving on to Chapter 2. Part of that safety net involves protecting yourself from invisible threats like inflation. Now, you might think stocks automatically save you from inflation, but they really don't. Just look back at the 9% stagflation we saw in the 1970s. It absolutely ravaged portfolios, basically cutting the dollar's purchasing power in half. So what do? Well, you have to look into things like REITs, that's real estate investment trusts, and TIPS, or Treasury inflation-protected securities, to really shield your money.
And just as you can't ignore inflation, Chapter 3 reminds us that you absolutely cannot rely on the past to predict the future. Assuming the market's future will magically mirror its past is a dangerous game. I mean, Wall Street experts confidently predicted the late 1990s tech boom was just going to continue forever, and they looked completely foolish when the Nasdaq crashed from 5,000 points down to roughly 1,300 by 2002. The takeaway here? Whenever you're in doubt, always choose the path of caution.
So to navigate this wildly unpredictable future, Chapter 4 shows us that a defensive investor has to look inward. They use their actual life circumstances, like their job security and cash needs, to build a balanced portfolio, keeping anywhere between 25 to 75% in bonds. You should completely scratch out those flawed age-based rules of thumb from your playbook. Your actual life dictates your risk, not your birthday.
This defensive mindset totally applies to picking stocks in Chapter 5 too. If you're going to skip doing deep financial research, you have to avoid that dangerous buy what you know mantra. Remember when Barbra Streisand bought Starbucks stock just because she liked the coffee? She completely ignored the valuation metrics. Instead of doing that, the defensive investor skips the massive stress of stock picking entirely and just uses dollar-cost averaging to buy broad, boring index funds.
Wrapping up this first section with Chapter 6, even aggressive, or what Graham calls enterprising, investors must ruthlessly avoid toxic assets, especially initial public offerings. IPOs can be lethal. Look at VA Linux. It spiked a crazy 697% in a single day, despite losing money on literally every sale. And then it plummeted from $239 all the way down to $1.19 3 years later. Seriously, just stay away.
All right, moving on to our second section, Mr. Market in Psychology, Mastering Your Mind. Let's draw a line right into how market psychology tests your emotional discipline.
Now, Chapter 7 presents a really fascinating paradox. Did you know that even incredibly great companies can become terrible investments simply because investors overpay for them? It's true. In the 1990s, heavy hitters like General Electric and Home Depot grew massively, but their stock values crashed soon after just because their price was way too high. Value is what matters most. You have to hunt for bargains in unpopular, large companies that are trading below their net working capital. And this tendency to overpay? Well, Chapter 8 tells us that comes straight from the manic-depressive Mr. Market. He is wildly irrational, guys. During the euphoric highs of 2000, he valued the software firm Inktomi at an astounding $25 billion, only to slash it down to $40 million by 2002. Daily prices are practically nonsensical. Never, ever let Mr. Market's mood swings dictate your financial destiny. Because Mr. Market is so incredibly erratic,
Chapter 9 proves mathematically that a boring, low-cost index fund will almost always beat highly paid professional fund managers. Why is that? Well, because most mutual funds are just dragged down by toxic trading expenses, sky-high management fees, and what Graham perfectly describes as sheepish herding behavior. Now, if you do decide to seek professional help in Chapter 10, keep this in mind. A truly trustworthy financial advisor isn't there to promise you spectacular returns. In fact, if they do, that is a massive red flag. Instead, their real job is to act as a shield against your own impulsive tendencies. They're there to enforce a strict asset allocation plan and basically prevent you from panicking during those inevitable market crashes.
Part of that impulse control in Chapter 11 means actually doing the hard work of thorough security analysis. This is what protects us from accounting magic. Think of Global Crossing as a doodle in our notebook here. They artificially boosted their assets by classifying routine expenses as capital expenditures right before going entirely bankrupt. You really have to evaluate those long-term prospects and verify their financial strength yourself.
And Chapter 12 gives us another cautionary tale of accounting magic with Quest Communications. They aggressively booked $2.2 billion in revenue upfront. And what happened? It completely destroyed 90% of its stock value. This perfectly illustrates exactly why we must never trust a single year's earnings and why we have to actively watch out for those sneaky pro forma booby traps. Let's transition over to our final section, stock selection and safety, the final defense. Here's where we uncover the ultimate rules of lasting financial wealth. The very first rule of selection in Chapter 13 is avoiding market hype. Back in 1999, the market absurdly valued Exodus Communications, a company bleeding cash, at $21 billion, all while totally ignoring quietly profitable companies like Expeditors International. And surprise, surprise, Exodus went bankrupt just 2 years later. Market hype is an absolute trap. So instead of following the hype, Chapter 14 says the defensive investor demands strict quantitative criteria. We're talking a PE ratio under 15 and current assets that are at least double the current liabilities. You basically just wait for market panics to buy great companies on sale. A perfect example, Ballcord. It became a massive bargain at 12.5 times earnings following the 2002 panic, offering a perfect safety net. For those of you willing to put in a bit more elbow grease, Chapter 15 outlines the Warren Buffett approach. Enterprising investors hunt for franchise companies during temporary market panics, and they absolutely refuse to overpay for future growth. You'll want to focus heavily on the return on invested capital and look out for secondary companies that are trading right at their 52-week lows. But when you're looking at these companies in Chapter 16, be on the lookout for massive red flags. Graham does not mince words here, guys. He literally calls stock option warrants a near fraud. They are completely skewed to benefit the issuing company, they fabricate imaginary market values out of thin air, and they dilute the true earning power of the common stock. It is genuinely the worst of both worlds for an intelligent investor. Want to know another massive red flag from Chapter 17? Extreme overvaluation, rapid empire building, and massive debt. Just sketch out the story of Tyco International in your mind for a second. Tyco became this wild acquisition machine, spending $37 billion on 200 companies in a single year. And the result? Its stock plummeted 71% when inevitable reality finally hit. And the core lesson across all these examples in Chapter 18 is simply this: fads fade, and reality always returns. In 1999, the market went crazy and overvalued Yahoo at 3,264 times its earnings. Meanwhile, a boring company like Yum Brands, which had 17 times Yahoo's revenue, was largely ignored. But once reality set in, Yum actually posted a 25% gain, while Yahoo lost 92% of its value. When that reality does return, Chapter 19 reminds us that you, the shareholders, are the true owners of the business. Never forget that. You must demand dividends if management isn't reinvesting cash efficiently. Protest those overpriced buybacks. Look at Oracle. They squandered $5.3 billion buying back their own overpriced stock just to offset executive options, which destroyed massive shareholder wealth in the process.
Finally, we close out our visual notebook on Chapter 20 with the ultimate rule, the margin of safety. This is the absolute secret of sound investment, buying low enough to absorb those inevitable market miscalculations. Without it, well, you might find yourself waiting 43 years just to break even, kind of like the folks who bought JDS Uniphase back in 2000. So, as we wrap up this explainer, I want to leave you with a question to sketch right into your mind. Do you really have the emotional discipline and the character to be an intelligent investor?